So let's start. Hi and welcome to this webinar on the topic Managing Transaction Readiness, proactively increase your valuation. The current market is continuously changing and becoming more challenging for companies looking for funding. Investors have more resources and also taking more time to evaluate potential investments. And as a result, companies seeking funding may face difficulties from prolonged and expensive due diligence process to lose opportunities. And the aim of today's panel is to help you understand valuation, how to measure it, and the implication it has in the current economic situation. So here we are. My name is Emily, and I'm the Vice President of Marketing here at Younium. It's lovely to see so many people meeting up with us this afternoon. And if this is the first time you meet with Younium, we are a B2B SaaS company specialized in helping other B2B SaaS companies handling their advanced B2B customer subscriptions. And as with the many other SaaS companies, we are also on a growth journey. Last year, we entered the US market, and our CEO, Niklas Lilja, he relocated to the US before Christmas, and he's now starting up the operation there together with our US team. So if you are around, we have our office in Philadelphia, approximately 1 hour from New York, so you can meet us there also. And with that said, I'm handing over to our moderator of today, David Reiling.
Thank you, Emily. I appreciate the introduction. Let's see, good afternoon, good morning to some, good afternoon to others. I've got our panelists now joining via video. And what I'd like to do, first of all, is thank Emily and Niklas and Younium for hosting the session. I think it'll be informative to all, and I look forward to sharing a lot of information with you this morning from our panel. First of all, let me introduce our expert panel. I'll go around the room. First of all, myself, just acting as moderator, David Reiling. I'm a longtime SaaS and technology and software, been in the business and the profession nearly my entire career. Former C-level executive roles with several large SaaS providers, and I've had the good fortune to be part of several events, acquisitions, IPOs, et cetera, and I'm very familiar with the process associated with valuation for companies, and I've had a lot of customer-facing roles and very close to that aspect of the due diligence process and valuation, and hope to share some of those insights. Next, I'll let Mads introduce himself. Mads, are you online?
Hit that unmute button. Hi, everybody. My name is Mads Kunoff. I'm a director at Ernst & Young, based in Stockholm. Ernst & Young Corporate Finance, to be specific. So we're like a M&A boutique within Ernst & Young. So if you think of me that way, I have a background in various boutique investment banks previous to EY. And my specialty is software, M&A and fundraising. There you are. I'll pass on to the next panelist.
Thank you, Cedric. I believe that's you.
Hi, my name is Cedric Knotts. I'm a former, used to work in finance and in startups in San Francisco before founding Float and being the current CEO. Float is a digital platform based in Stockholm that provides loans to SaaS companies. Float has built a very flexible loan product that is tailored for the SaaS market. You can apply for a loan within minutes and get an offer within 72 hours, removing the current uncertainty around equity funding, which is currently taking about 6 to 9 months today.
Thank you. I think we'll pass over to George. George, are you there?
Yeah, hi, good afternoon and good morning. This is George Buenzalita with JLA Advisors. We're a boutique strategy and technology consulting firm focused in the telecom industry, the private equity and VC industries, and the software industries. I've spent my entire career in and around software, telecom, and technology. So this is sort of a continuation And specifically for software firms, we like to support SaaS clients in their growth phases, particularly as they have achieved certain scale and are looking to go beyond that, and inspiring discipline around R&D, product, sales, customer engagement, et cetera. Thank you.
Thanks, George. Art, I think we go to you.
Hi, my name is Art Bijkerk. I'm the TMT lead at Fidelity Corporate Finance, mid-market M&A boutique in the Netherlands. Some years experience in exits and majority deals for entrepreneurs and investors. I have a focus on software M&A, a typical deal size, let's say between 25 and 150 million euros.
Thanks, Art. And then finally, we'll go to Johan.
Yeah, hi everyone. I'm Johan Kastervall. I'm a co-founder of a Swedish SaaS investment firm, Parting Capital, investing in tech scale-ups. I've also worked more than 15 years as SaaS tech entrepreneur and C-level executive in various roles. And I've made an IPO at Nasdaq First North as the CEO of a tech scale-up XM Reality in 2017. And also supporting Younium as CFO.
Wonderful. Thanks for all the introductions, everyone. And I neglected to ask for locations, but suffice to say that we are spread across the globe. We have several of the members on the panel here today in the Nordics, as well as several in the US. So we're trying to bridge the gap. Now I'd like to transition into the actual discussion. So I'll stop sharing the slides and we'll focus on the panel. As we join into the conversation, first of all, what we thought made sense was first establish sort of a foundation for everyone. As we think about valuation and the activities required for that, specifically in a recurring business model, we've seen the sort of the traditional business model of transactional activity give way to that of a recurring revenue theme. And when you're in a recurring revenue model in that context, many of the metrics that we've been familiar with have given rise to new ones, things like ARR, ACV, churn, customer lifetime value, time to value, net promoter scores, customer acquisition. Hopefully some of these begin to ring a bell with you and you're familiar with those. This panel is not intended to give you a deep dive into the definition of those. What it's intended to do is help you to consider which of the metrics associated specifically with recurring revenue models are appropriate and applicable for the valuation process of those kind of companies, and also what priority should be given to them in the valuation process. There's a variety of financial metrics, customer performance metrics, product performance metrics. How do we prioritize and apply those to the proper use in evaluation process for future funding opportunities? So we're going to hear from a few of the panelists here from their perspective, and if we'll allow, I'll start with Mads perhaps and give your thoughts on the applicability of which metrics and the priority of those.
Sure. Thank you very much. Yeah, so it's I guess it's a bit of a moving target. If you'd asked me 18 months ago, it would have been a different answer than today. So I think we've shifted from quite a focus on high growth and also ARR figures. So the first thing I think investors look at is sort of was the growth rate and the sort of absolute ARR figure and how fast that's growing. And there's a host of other metrics that continue to be important, and those I mentioned are not unimportant. But obviously, there's been a shift towards thinking about EBITDA profitability, and within that, more specifically, people like to see what's called cash EBITDA. So if you're capitalizing your development costs, people like to have a look at what it would look like if you're actually expensing your development costs in the P&L. So yeah, renewed focus on profitability. That's always the case in downturn situations. But I'd still say ARR and the absolute figure there, that's a very solid indicator. And if that's growing, that's what people like to look at. And then, of course, you have a host of other metrics that I'm sure will come up, and I won't steal everybody's thunder, but we'll go into those in more detail. But that's sort of the high level, maybe answer to your question. I think you're on mute now.
Everyone will be guilty of that at least once. Thanks, Matt. So perhaps from a different perspective, let's go toward sort of the funding aspect of this. And with Cedric, as he introduced the company, they have a little bit of a different approach as it relates to funding. And so, Cedric, with that lens on, what metrics do you find most applicable, and how do you prioritize those?
Yeah, so we as a lender, the KPIs that really matter for us, and I would say when we look at companies, it's good to be clear. They're typically like companies that are in the building or scale up phase, so pretty much SME. So typically the ARRs we're looking at are around like €500,000 to 10 million euros, and in this sector, what the important KPIs for us are like, the growth rates are, well over 30%. The rule of 40 is positive. And for those of you who don't know what the rule of 40 is, it's basically your growth minus the burn as a percentage. The LTV to CAC is greater than 3. The net revenue retention, the NRR, should be over 100%. Your monthly churn shouldn't be much greater than 2%. Your burn multiple should be less than 2. The burn multiple is basically based on burn versus revenues. Runway of, let's say, at least 3 months if you're looking for debt financing, and your customer concentration shouldn't be too big. I mean, these are just some of the KPIs that are quite important for us when we look at potential clients. And then I would just say that I agree with Mats about the 2023 is still very much a risk-off market right now, which means that companies need to be more focused on achieving break-even than they did in 2021. However, there are different ways of doing this, right? So you can either cut costs or you can increase revenues, or a mix of both. For us, what we've seen in this market, for the most successful SaaS companies out there today raising capital, are the ones that actually increase their revenues. They focus on increasing their revenues. This is really important because a lot of companies are, very focused on cutting costs, but it's actually the increase of revenues that matters, because if you're going to raise money, VCs are still looking at, high growth rates. So to do that, there's 2 options. It's either that you optimize your costs and, really analyze where most effectively the money is being spent on marketing and sales, but also finding alternative funding sources to be able to continue that growth path. And one of the reasons is that still these companies that focus on growth were able to maintain also a very motivating and constant work culture, rather than the cost-cutting companies that have lost motivation for a lot of the people working there. And if you can keep that growth, as a result, also you have an increase in productivity and expansion within the team and the motivation of the team.
Thanks, Cedric. Truly a relevant comment, right? As we all know in the headlines today, we see so much emphasis on cost cutting and the tech sector, but really relevant as far as growth and revenue comments. Thanks. So Art, maybe we shift over to you again from the funding and the perspective of those doing the evaluation, the decisions. What are those metrics that are really driving your decision criteria, and how do you prioritize them today?
Yeah. So thanks. I think, of course, cash EBITDA and cash generation is very important, especially considering exits. And there are a couple of these metrics that we look at that are sort of guarantee that you will be profitable in the long run, or are on the short run already. So, for example, the net revenue retention that Cedric also mentioned is a very good measure, as it combines a couple of things for your current client base. So It combines churn, upsell, and downsell. What you basically want to do is generate more revenue from the clients that you already had. And if you combine that with LTV over CAC, so customer acquisition cost, if that's in the good, let's say, that's a good ratio in a range of 3 or 4, it guarantees that you're very effective in adding new clients to that already growing client base. So that's a nice combination that we really want to look at, and it determines also the positioning that we have when selling a company, or at least bringing it to the market.
Excellent. So good responses. You know, this theme or this question was intended, as I said, to set up a bit of a foundation for the rest of our discussion. So hopefully you understand those metrics. We've heard a lot about ARR and growth, and we'll continue to hear that through the conversation. But there's others. So before we move on to the other examples, next let's talk about then perhaps more detail or examples about how we actually apply some of those metrics and the best practice for not only gathering those metrics, but also for validating the financial integrity. So we all know everyone shares everything perfectly, transparently, and there's never a question as to the validity of any data. Well, perhaps maybe not. So what I'd like to do in this round of questions is just get a little insight into not only how we gather information that leads us to those metrics, but how do we use our judgment and validate the integrity of those. So specifically, you know, when you're assessing the value of a company and trying to validate the performance data that allows you to create these metrics, it's critical to make sure that it's calculated in a way that'll, you know, stand up to the rigors of a due diligence process or a deep financial analysis that accompanies as a funding opportunity. So perhaps you could share an example or two of a best practice or an example where you've not only figured out where and how to extract the information to lead you to these metrics, but also how do you get a feeling to confirm that financial data's validity while you're in the midst of these funding opportunities and evaluations? And I think we'll start right back with you, Art. Perhaps you've got a thought or an example on that.
Yeah, so it's a good question, a very relevant question as well, because I think we're currently in a process of bringing a company to the market where we actually have a Big Four company checking those numbers because they are so important, and it's quite expensive if you haven't done the good groundwork already. So I think for all companies, if you look at a certain KPI, you don't really care that much about a specific number at this moment, but you also want to see the trend, right? So if you start looking at, for example, net revenue retention, you don't want to look at only the last month or the last year, but you want to see what the trend is doing, whether it's going up or down, and then dive into that deeper, which means that you really need to have the foundation to drill down to those numbers to have a very good understanding. So yeah, and that means basically that you, especially if a company is young, and you see that a lot with scale-ups, that you already, of course, you started in Excel or in some kind of a Google environment where you shared some numbers, and then you made a change to a bookkeeping system, and then and if you want to see the 4 or 5 year trend, you need to combine those numbers, which is well, let's say can take quite some time, sometimes 2 months even, just to have a good understanding and to start off thinking.
Excellent. Yeah, a lot of trails to follow there in terms of validating it. And maybe another perspective, again, from those that are doing this on a regular basis, constantly doing evaluations and analysis. Mads, in your world, what are some examples of how you not only gather, but really validate that information?
Yeah, I mean, I think Art sort of talked about Big Four. It doesn't have to be Big Four, but what a trend we're seeing increasingly is that clients are using financial due diligence. They're executing that in advance of going to market, and especially you know, many of these fast-growing companies that sort of come out of nowhere, they may not have a very good handle on their numbers, or even mature companies often don't have a good handle on their numbers. So you either go through the pain of looking at that and trying to get your stuff together during due diligence, and it takes a long time, introduces risk, and can affect valuation, or you do the work beforehand. And ideally, you've been doing it over years. You've been keeping track of your KPIs, and you've got a really good handle on your financials. In a fast-growing startup situation, you often haven't got time to maybe do that. So at the latest, when you're looking to raise money or doing M&A, then it's time to get your books in order. A very good way is to use a third party like a Big Four or any other reputable accounting firm to produce what's called at least a data book. So this is sort of Excel spreadsheets that put all the numbers into a fairly standardized format, and where you also can glean the KPIs from these numbers. So investors tend to place a huge amount of trust in third-party produced documents like that. So it does cost money. When we have a mandate at EY, corporate finance, we don't necessarily advocate using our colleagues. We're not always trying to sell in extra services. We're happy if you go to PwC or somebody else to get this work done. But it's so much easier to raise money or sell a business if the numbers have been looked at by a third party. And it's typically not either what the M&A advisor can do or should do in depth to the level that's required for doing deals.
Great responses. So I think, it's worth pulling out there that we've structured this panel and this conversation to give you a lot of insight into what people who are actually doing the analysis, as well as perhaps, making some of the decisions about funding. But for those of you on the call who are thinking, well, we're perhaps a company that will be the benefactor of funding, or an event of some kind, and we only go through that once, perhaps in our life cycle, or maybe once or twice in the companies. Why should we have something that is as Mads described, very structured and familiar to all those? Well, it speeds the process. It puts it into a common format, a common approach that, as Mads alluded to, it gives the investors and the funding entities the ability to very quickly move to decisions and validations and so forth. So even though you're not in the business of providing analysis, it may benefit you to be able to use similar tools, similar techniques, and similar approaches to provide that data as part of the process. Great talk track. So I'll move to our next sort of theme here. And Mads was my precursor here in giving us a little perspective on the idea that, we all read the headlines. We're all familiar with what's going on out in the global markets. And we've really seen that, the pendulum has begun to shift back towards profitability in favor of what was a pretty strict growth and even hyper growth model that defined a company's success criteria. Now, with some of the uncertainty in the global markets, both last year, now continuing into this year, and a change in sort of decline in overall IPOs, even some aspects of institutional bank investment, there really is an increased need for having a very rapid and accurate representation of company valuations. That's what people are needing going into the funding opportunities that do exist now. So I'll pose the question here to a couple of others on the panel. How does the current situation impact how you look at funding opportunities and advise against those versus perhaps what it did 18 months ago in that process? And maybe let's hear from a couple of different folks here, starting with Johan. Johan, for instance, how do you look at things in that scenario different than you may have?
Yeah, I mean, I for sure think that in the European market is for sure that cash flow has a significant higher importance today than 18 months ago. Obviously, as a scale-up investor, I mean, growth for us is of vast importance. But I think the the knowledge of the management team of the companies to know their runway and to have a 360 view on the financing of the companies is much more important today than just a couple of months ago. I also agree that what used to be maybe the rules of 40 is closer to like rules of 50 or similar, and that it's to be really attractive growth case, you need to show beyond 50% year-on-year growth, I would say, to be really attractive. And I think that obviously we heard the profitability as well, and I for sure think that to keep your books clean when you talk to investors and make sure to not confuse investors with product capitalization of software, but show that you're on top of things and that you know your runway. I think that is more important today than a couple of months ago.
Great advice, great perspective. George, I'll shift over to you. Let one of our colleagues from the US share your thoughts on some examples or where you've seen that change over the last 18 months. I'll let you go off of mute as well. Everyone gets theirs.
Yeah, sorry, that's my. I'll contribute $1 for that. So in the US, I think we see a fair amount of similarities, but maybe with some distinctions. First of all, for smaller companies that don't have that path to profitability, it has been extremely challenging. Unless you're sort of supported by a tier 1 VC, we have some clients and some folks that are close to us that are having a tough time with what's that next journey. However, when you are supported by a patient investor, a VC that's comfortable with the SaaS model, we've seen maybe less of an increase in those targets from 40 to 50, but more around, hey, we're comfortable with this. Maybe it'll take an extra year. So a little bit more patient, as long as some of these the dynamics are in play. Absolutely, the funding to fund is very tough. So it needs to be funding for cash positive or already cash positive. But then, as a company, as we're giving advice, it's important to understand the stage. In the first stage, it's all about proof of concept. Then it's about getting your customer validation and growth. But very quickly, the metrics that maybe were ignored early on all of a sudden become important. What's your sales efficiency? What's your R&D really doing? Because investors have been very comfortable investing in R&D, but sometimes that becomes a very large expense, and it's a catch-all for maybe some sins that are going on in the company. And then certainly that's when the ARR number starts coming into play, and from there on. So we certainly see that companies that understand which metric is important at which point in time, and then understand what's behind that metrics and how to behave, are the companies that will be successful in today's market.
Great, thanks, George. So we've covered a lot in terms of metrics and analyses and data. We've also mentioned that we're trying to provide some insight and perspective for sort of both sides of the funding equation, those providing the funding and how they make their decisions, also those who are receiving the funding, companies who may be looking for opportunities, as you've heard from several of the panelists today. So let's shift a little bit, and I'm going to put our more financially oriented experts on the spot here with a talk track around. So we've got a CFO and we've got a corporate finance consultant on the panel here. But many times you're going to need to take the information that you've uncovered or developed and sort of translate that. It's got to provide it to a wider audience, a broader spectrum across the executives in a company or the investors, et cetera. So in the new paradigm of this recurring business model, it becomes even more important to be able to communicate pretty complex financial metrics that people might not be as familiar with into really digestible information, business data that investors or executives who are not as financially oriented can use as part of their business logic, to make decisions in the process of funding or evaluation, et cetera. I'm wondering if I could get a couple of examples or thoughts from you on how you translate and take information to be able to provide across the spectrum of people, stakeholders and constituents in the evaluation process of financial information to make it digestible and usable and action-oriented information. Mads, I'll turn back to you for some thoughts there.
Sure, and we talked a bit about it beforehand, and I was a little unsure how to answer, but I think you can you can boil it down to what is it a business really should be delivering, and it is at the end of the day, it is ideally it's happy customers who stick with the product and keep paying. It is so it's low churn. That's a concept most people, I think everybody understands. You're super interested in things like ARR. Most people, even non-financial, understand that cash flow is important. So hence the cash EBITDA concept and growth overall. So I mean, I think it's easy to get confused by new KPIs. There's new ones being developed all the time. I keep discovering things I didn't know about before, and you sort of think, oh, I'm an idiot because I don't know this latest KPI measurement. But I think it's easy to be confused or dazzled by all these things, and so when I want to communicate to sort of a more mainstream person or a non-financial, at the end of the day, people understand. They understand revenue. Most people nowadays understand ARR. They understand EBITDA and cash EBITDA. You may have to explain the difference between EBITDA and cash EBITDA. It's not that difficult to understand the difference. And there's a number of other metrics that gross margin and annual contract value and things like that, which and even net revenue retention. I'm not sure sort of the man on the street really understands what it is, but you can fairly easily explain it. So, when we present, we use management presentations and really focus on graphics and a few punchy numbers that summarize, do you have happy customers? Is your revenue growing? What percentage of your revenue is recurring? I think anybody can understand nowadays that you like to have this recurring bit. So that's really what we focus on when we present an investment opportunity to, and it could be, trade buyers, it could be investors, but to get the conversation going. So I think that would be my quick answer to that. And if you want to get into more detailed things like net working capital profiles and net debt calculations and things like that, we can talk about that. But that's where usually you start losing people who are not financial experts.
Good answer. I love how the financial expert couldn't resist at least mentioning a few of the ones, but great answer for how to sort of translate. Johan, perhaps your thoughts on a similar vein. How are you able to communicate effectively?
Yeah, I think it's hard to not mentioning annual recurring revenue, and especially since it creates a very good visibility of future revenues and income, and obviously that relates how the accounting experts love allocating revenues every month. So I think that's for sure one important metric. But I'd also like to mention the fact that it's important to keep your accounting correct. I think it's really important to have some kind of subscription management system in place so that you are aware of, how is the customer using the software? Has it been activated? Has the service been turned on? And that makes sure that you have an alignment between your accounting and the actual service that you're offering. It's very important from accounting perspectives. Other than that, as Mads mentioned, I think there's a few more very, very important indicators to SaaS companies searching for funding. I think it's important to identify the KPIs and metrics that shows the momentum of the company. I think a lot is down into ACV bookings. I mean, the new deals that you have, it's not visible in the accounting yet because you maybe signed the deal and you're about to deliver later on. So I think make sure to keep track on your new bookings. Also sales pipes when it comes to really show sales pipes materializing and conversion rates. And I think that is a good complement to the ARR, which more of like lagging indicators showing what you've already accomplished. So I think keep your eyes in the front window and not only in the rear window.
And can I just jump in there on the sales pipeline? I don't think I have so far seen a client that can show their sales pipeline, how it has developed over the last 2 or 3 years. This is practically unheard of because I think people hate tracking that sort of thing. But it would be so valuable to have that, to show the momentum, as you want to say.
And I could add just one little thing is for us, like what we see in this current market where, you know, companies are cutting costs and trying to control their costs, the NRR is like fundamental because it shows you that without spending more on marketing and sales, can you increase revenues basically after churn. So this metric in today's market is really, really relevant.
Yeah, it's a perfect segue. Thank you for the answers into our next sort of topical area, which focuses on, you know, some of the other impacts to valuation are not just the sort of traditional and strict financial metrics. You know, how do the customer and market impact valuations as you're going through the process? And you've heard a few teasers on that throughout the comments. You know, the subscription economy, the anything as a service kind of model has really introduced a lot of these new indicators that we've alluded to and in fact specifically talked about how to apply so far on the call. But customer behavior and market outcomes are a huge part of that as well, as you just heard all three of our panelists allude to. Things like churn, how we treat that, and net revenue retention. They have to be considered as part of the due diligence and analysis process related to funding. Although they're not really the traditional financial metrics, they can have huge impacts on the evaluation of the company's performance and then the resulting valuation of the company. And this is something very, you know, I'm very passionate about and have spent most of my career focusing on, which is those elements associated with customer and market. So we've heard mentioned several times about churn. For instance, it is in fact a huge indicator and valuable metric to be used in the valuation process. You know, Cedric alluded to this just a moment ago, and I believe Johan did as well. The thing about churn is, you know, all churn is not equal. So first of all, let's think about size, segment, and product. The size of your company, the size of your market, may indicate the type and amount of churn that's acceptable in your particular niche or your segment of the market. The size of your company may indicate that. And the product itself may in fact have an impact on the type of churn that you experience. So for instance, you may have a market segment that's consisting of a lot of very volatile elements of like a B2C market where there's a lot of movement and volatility. And churn in that context may, in fact, we heard mentioned earlier, 2% per month. That may be perfectly acceptable in a volatile market. In fact, even more. And in a situation like that, you have to consider how you're managing your churn. You can't make it go away. What you want to do is manage that most effectively such that you're replacing it with growth and expansion revenue, as was mentioned, that creates your net revenue retention. So think of the sieve model, and I hope that translates into a Nordic word, but the thing that you use to drain your pasta, when you put the water in, some goes out, you need to make sure that you're putting some back in to retain that and make sure that your revenue overall, and you're getting that additional revenue from your existing customer base, okay? That's the net retention model. Likewise, you could be in a market where churn, for instance, you may have a very stable customer segment, companies that don't make a lot of change over the years. You may have, very consistent contracting models that are multi-year. You may have a sticky product, one that's very challenging from a switch out. It's very expensive and difficult to actually switch applications or platforms or solutions. Therefore, the churn in that market might be very low. I've been involved in companies where, we were at 98, 99% retention, gross retention. So not losing a lot of churn. But in that scenario, as our panelists alluded to, it's hypercritical that you're understanding exactly where the churn trend has been in the past and is going in the future, because one customer churn in that scenario could indicate a huge detriment to the valuation of the company. And the last thing I'll mention about churn is, and I think, Johan, you mentioned it as well, is I think the most important thing you have to consider with churn is the fact that it is not a simple snapshot. A big mistake that you can make is to take your historical churn numbers and try and derive, the best intelligence from that, and not look at how you apply the trends of those churn numbers and have a proactive vision for where the churn will be in the next quarter, in the next half year, in the next year. Mads alluded to it in the terms of a sales pipeline. Many times, we don't like to look at the historical in a sales context. We only want to know what's coming down the pipeline. Well, it's often opposite in churn. We spend a lot of time to analyze the churn activity that has happened and try and do a cause analysis, but then we don't take that information and proactively extrapolate what's going to happen in the future. So it's a huge opportunity to be able to use churn to your advantage to predict where your company is going to go. And that's what a lot of the funding entities want to hear about. They want to know about that unknown. George, I've hit a lot of concepts.
Yeah.
You add to that?
Yeah, no, absolutely. So when you think of where we just came from with valuation, SaaSes a year ago were valued extremely high, anywhere from price to sales of 5 to even 20 plus. And the growth expectation was very high. And now the valuations have pulled back, and now it's back to more of the fundamental metrics that David and others have been speaking of. And churn is front and center, and churn ties right into NRR. So if you're now only growing at 2% per year, but you're churning that same 2%, then it becomes a front and center problem. And so what you do about it in terms of inspiring your customers each and every day. If you're in a B2B market and you've been lucky enough to sign a 3-year contract, you may have done something in those first 4 months that will ultimately predict that churn at the back end, and you realize that you've been in this uncomfortable moment for an extended period. So you need to continue to win your customers each month. There are no shortage of aspects as to how to do that, from pricing to support to being proactive and so forth. And it ultimately comes back to more of a traditional set of metrics. I mentioned I came from the telecom industry. So not too recently, when we would advise our telecom carriers, you could find the customer lifetime value, and that's another sort of term that we're importing. On a prepaid customer, it might have been $100, literally $100 customer lifetime value. For a high-end iPhone customer, corporate liable account, it could be $3,000. So 30 times difference in that individual customer. And that's where those kinds of metrics will absolutely now play in more prominently on valuation.
So as you can see, there's a lot to consider, both in terms of the financial as well as the markets and customers that impact valuation. I hope we've given you a good perspective on that. I want to take this last couple of minutes that we've got left here in the session to allow all of our panelists to weigh in on the future considerations. So armed with this information, knowing what impacts valuation, what's the key metrics, what are some of the trends, where we are now versus where we've been over the last 18 months, there's still a huge opportunity for investment and return in the current market. Obviously, that's why all of you are here, and that's why we're here as well. But it does require some new perspectives and new approaches on how we evaluate the potential future success of companies and the funding that they may garner. So what are, I'll go around the panelists here and sort of get what are some of the key themes emerging that determine how your future funding decisions are made today. And I'll ask you to give sort of your soundbite, if you will, each of you, maybe just a sentence or two about what are the emerging and future trends that you see most important as to how you engage ultimately in providing and delivering valuation estimates for companies and the opportunities you're involved with. And this is in no uncertain order, so I'll take it as the blocks go. George, I see you first. So how about your soundbite for the future?
Yeah, well, I think the future is to go back to what you stand for as a company. So becoming product led and you're having conviction around that product. We see that the drifting into chasing every shiny object occurs. You have that ARR pressure, you're chasing after it, you're hitting that metric, but maybe doing so at the expense of focus and even culture, right? If the staff doesn't understand, where the main priorities are. I think I said more than one sentence, David, so I'll pass it to the next one.
Thank you, Cedric. I'll let you jump in with your sentences or your soundbite, please, for the future.
For us, really, data quality is super important. And what we see, especially for debt funding, what we see is that larger companies, larger SaaS companies use some sort of subscription management software, but smaller companies don't. So I think it would be great to see more small companies using some sort of subscription management software that shows us that they're really on top of their KPIs.
Great advice. Yeah, perfect. Mads, I'll shift to you. What are your thoughts on the future?
Yeah, no, I think those are good comments. And I'd like to sort of piggyback off Cedric's comment. And I really like the float idea of a very digital, very fast track lending platform. This is unheard of. And I mentioned it to a colleague the other day. Said, yeah, I just picked up about that too. And so I think you're onto something there. And I think in connection with that, I would say digitalization. So what we're talking about today, this kind of tracking of KPIs has not been done very digitally, not done in a very good way before. But there are tools now, and this is the sales pitch for Younium, of course. I think these kinds of tools will proliferate, and there's no way back. It's the way forward is to use these kinds of methods and get a better handle on your numbers and on your KPIs. And I think having the discipline around that makes life easier. It's also easier to manage your business. It's not just about doing transactions and dressing the bride for the big day. It's actually managing your business along the way. I think that should be the real reason you do these things. And then when somebody looks at your business or you want to get funding, then you have it all there. So that would be my 5 cents worth.
Thank you. Well said. Art, I see you next in the block. What are your thoughts as we think about the future?
Yeah, so being in M&A makes you a little bit opportunistic, right? But if you are on the good side right now and you have a profitable business and you feel that your valuation is not high enough, that's a great opportunity, of course, to try and acquire a competitor or something like that. And that's something that companies haven't really looked at the last couple of years because those valuations were high. But in a market that is, let's say, not as hot as it was a couple of years ago, there could be an opportunity in the near future. So that's something that people could consider.
Good perspective. And we'll have one more comment. That'd be from Johan. Johan, your thoughts on the future?
Yeah, I think as a SaaS company, it's always super important to keep track of your growth momentum KPIs. Make sure you're top of your new bookings related to sales and subscriptions. And in order to not miss out on any billing, any uplift of prices, etc., in this inflation time, I think it's super important with the subscription management system so that you're on top of things. Also make sure that you're on top of things and know your runway. Make sure to have a 360 view on your runway and look into different types of funding.
Great advice, good perspectives on the future as well. So as we wrap up today, I did see a few questions that came through in the chat. I'm sure there may be others as well from today's discussion. I hope there are some that were stimulated. I'll turn over the meeting here in just a moment to Emily to let us wrap up. If there are other things that you'd like to dive into more or get more information from those on this call, please reach out to Emily and she'll let you know how to get in touch with her to be able to continue the discussion and perhaps address some of your questions. Finally, I'd first of all like to thank our panelists. Thanks to everyone for joining around the globe and providing your insight and perspective on this exciting opportunities that are out there for funding, new and innovative ways of finding that funding. So thank you for your participation. And then finally, Younium, thanks for hosting us. We appreciate you guys sponsoring this discussion and allowing this information to flow for everyone. And I hope that all of the attendees got some benefit from that. I look forward to seeing you in the future. With that, Emily, I'll turn it back to you.
Thank you. And thank you everyone for being here with us today.